All right, what is up, you guys? In this video, this is the second part of the previous video, but like I mentioned, we're going to be going over a little more in depth into probability and profitability. You see, these are two mathematical terms that are embedded within this industry. Oftentimes, based on educator and mentor in this profession, you usually see something like psychology, technical plus fundamental analysis, and risk management as part of their table of contents, right? As in, that's the way, the sections that they're going to go through and teach you in order for you to become self-sufficient. So I think that mathematics is the most factual language, right? Because the numbers never lie. I think also that people need a refresher course in terms of what probability is and what profitability really is and why it's important for you to know these. And I think that's the basis that you need to build upon. And then, once you have that solid foundation understood, the truth, the factual information, then can be built upon, right? Now you have your technical fundamental, your risk management, and your psychology and paradigm, and know which one is more involved with probability, chart work, which one's more involved with profitability, the profitability, your equation to calculate your profitability, right? Your ability to profit. So I'm just going to go ahead and go right in. So a lot of this is going to be very repetitive because repetition is the way to prime your subconscious mind. And let's get right into it. Probability, the statistical portion of mathematics. This deals with your trading style or approach, a little bit of a history lesson. The fathers of technical analysis, if you can Google it, has to be Charles Wyckoff, Elliot Gann, and I forget the fifth one. And these were, the fathers of technical analysis, and this was in the early 1900s. So what that means is that any and every trading style or approach is derived from, the fathers of technical analysis, when technical analysis began. So probability or your approach, right? So when it comes to these different approaches or trading styles, I just want to express that they're all teaching you to take advantage of patterns, right? Because if you can identify at which point you're in within the particular price action pattern, more than likely you can predict the next move, right? And you're probably right. Once you have a probable trading style, you're as probable as the most probable trader. And that's really it. Everybody is looking at the same price action when it comes to a chart. Absolutely, everybody. The only thing that differs is, what trading style or approach are you utilizing? And this is one trading style and or approach from Richard Wyckoff himself called Wyckoff logic. You see how accumulation, then markup, and then distribution, right? And the reason we're able to, take advantage of patterns is because repetition allows for the aspect of predictability, right? Anything that repeats, more than likely you can bet or you can assume that it's gonna do the same exact thing since it just does that so much, so repetitively, right? You can see that in life and as in trading, as above, so below. So you see this is Elliott wave, and I learned how to teach all of this to support resistance, Elliott waves, and whatnot. And you see that right here is your bullish harmonic based on strict Fibonacci ratios, and then your series of 3, then 5 movements, and XABC, and your formation of bearish harmonics based on strict Fibonacci ratios, and the sell-off. But you see, it's the same thing. Everybody's looking at the same thing. It's just synonymous. Bullish bat is to accumulation as accumulation is to bullish bat. Distribution is to bearish and head and shoulders as head and shoulders and bearish harmonics are to distribution. Now, Market Maker Series, Steve Mauro. This is one of the newer trading styles, and again, derived and stripped directly from Wyckoff. But this is where you get the letters, right? The M, the A, the W defines the bear cycle. The W, B, V, M defines the bull cycle. I learned how to teach and trade with this style as well. And it's the same exact thing, guys. You can see the bearish harmonics, the bullish harmonics, the head and shoulders, the distribution, the series of 5 waves up, 5 waves down, and accumulation in terms of Wyckoff. And what do we see here? Same thing, head and shoulders. Therefore, everybody is looking at the same price action. Everybody's looking at the same patterns on the charts. Is just what trading style or approach did you learn in order to take advantage of the repetition, right? Patterns allow for the aspect of predictability. And that's pretty much it, guys. Your trading style or approach is meant to make you probable, and that's it. The only thing that differentiates between trading styles and approaches is just the terminology and the concepts, but pretty much the mechanism and the components are the same. The price action is the same price action. It's just aiming at the aspect of probability, trying to make you probable. And I think an accuracy rate of 5 out of 10 is fair enough. That means you took 10 trades and you won 5, 50%. That's well enough. Because everybody is probably learned the basic mathematics, right? A lot of people often hear, they raise up 5 fingers and they say, you can lose more than you win and still be profitable. Look, as long as you keep a 1 to 3 risk to reward ratio, just as an example, right? And they put 3 fingers down and you lost 1% 3 times at 3%, but the 2 times you won, that was 3% times 2. So 6 minus 3, that's net profit 3%. And when someone hears that, it's like, well, that means we can control something, and therefore anybody and everybody can do it. And that is true, but that 1 to 2 to 1 to 4 risk to reward relationship per order is a ceiling that 96% of retail traders never break out of. And like I said, it's better to go for a 1 to 10, 1 to 20, 1 to 50, 1 to 100. It's not that it's better, it's just more profitable. And knowing how is important, right? Because every vehicle of investment is for profit, right? And if you can show someone how to increment their profit through the reduction of their risk, their average risk per order, that's something you want to pay note of. But point blank period, guys, everybody's looking at the same price action. The terms may be different in terms of approaches. There's other styles that are mainly indicator based, and they got a bunch of indicators thrown on the charts. A lot of the times the risk reward is for a 1-to-1, 10 pip stop loss, 10 pip take profit, and that type of risk to reward relationship per order is just not appeasing or appealing to me, and I'd rather not even talk about that. Indicators lag; they give you the best entry after the fact, and trust me, guys, it's better to really learn smart money concepts and then really see both sides of the equation, right? 96% of retail traders, how they perceive the market, how they trade, and then how the big and largest world banks and or financial institutions perceive and trade the market. So in that way, you can step outside of the trading matrix, observe, and participate alongside the big players, right? And we talked a little bit about that on the previous video. So moving forward, which is most profitable? Everybody wants to ask, well, trading styles, allow you to predict market directions based on sequential patterns, repetition or patterns, allow for the aspect of predictability, but which of them, if any, is most profitable? We're aware that they're probable. Which of them, if any, is most profitable? So I do want to show you this before I go into the overlap. But well, you see, this is the overlap, guys. We've talked about probability. It's the mathematics involved in terms of probability for this profession is dealing with your accuracy rate, right? You want to win 5 out of 10. That's 50% accuracy rate, and I think that's fair, right? You'll never win 10 out of 10. Those are your given constraints. And yet, even if people are told that, they go through what I call the probability phase or the insanity phase, where They take the actions of looking for the best trading style, a golden indicator, the best signal chat service, not ever really understanding the mathematics and never really, getting over that insanity phase of, there's given constraints. You will not win 10 out of 10, but an accuracy rate of 50% is fair enough, right? You're simply meant to be probable with your trading style or approach. Now, the overlap is in precision, right? Because precision deals with your stop loss, right? Your stop loss is your profit moderator, your pip range parameter of risk. How much can you reduce your pip range parameter of risk or stop loss per order on average, per pair, per trade, right? And why is that the overlap? Because when we're dealing with probabilities, we're dealing with the graphical representation of the charts, right? We're marking up, we're using our technical analysis, fundamental analysis, other confirmations that I'll cover in another video. But just to aim at the aspect of probability, right? And then when it comes to profitability, you're dealing with the ability to profit, the equation for calculating how profitable that investment or that order can be, right? And we're dealing with your average risk to reward relationship for order and your trading plan. And just to cover the equation of profitability, it's dealing with your range of risk, time allotted, and range of reward. If you don't have that identified prior to entering into an investment or into an order in terms of day trading, you're doing it wrong. You need to know these calculations. This is the fun part, guys. This is the math that you need to know. You need to be unconsciously competent at doing this math. And then the overlap is in the precision, right? Like I said, because your range of risk, whatever percentage you place on your range of risk, your pip range parameter of risk, is dealing with the profitability, but it's also being represented to you or given to you through the graphical representation of the chart, right? You're analyzing the order, you're seeing, about how much you're willing to risk, and obviously what you're willing to risk has to be at least a reward of 4 times that. And we show you through precision how it is that you can break past that collective ceiling of a 1 to 2 to 1 to 4 risk to reward per order. Because rarely anyone asks, can I do a 1 to 10? How do I do a 1 to 30? How do I do 1 to 40? And if they answer, with time you'll be able to enter, and hold trades and with time, and you'll catch a 1 to 7, 1 to 8. That's wrong. The answer to that question isn't in terms of time, it's in terms of precision. And I'll show you through this example. So this is an example of a short opportunity. We're selling and we're making our money on the way down. Stop loss is above. You see how the stop loss is smaller than the entry, probably like almost 1 to 3, 2.78. But let's compare a swing trader. Swing trader, for those of you guys that don't know, they only operate on the higher time frames. And guys, we look only at the higher time frames. But like surgeons, we dissect and look at price action and enter into the lower 1 minute or 15, 30-second fractal. But a quality of a swing trader is they have a larger parameter of risks, pip range parameter of risks, usually 50 pips. Why? Because they have to account for price action on the higher time frames. Now, trade house sniper, we can enter with under 10 pip stop loss, right? What does that mean? Let's say that pair moves 200 pips, a little bit over its ADR. AU probably wouldn't. Its ADR is different, but that's not for here. Let's say that movement down was 200 pips. So therefore, the swing trader at 50 pips is capped at a 1 to 4, right? He has to capture 50 pips in order to make that 1%. Let's keep a risk constant or a constant risk amongst both traders at 1% for this example. So that means he's capped off at a 1 to 4, and he has to capture 50 pips on his side, to the downside in order to procure that 1%. All while a trade house sniper, if he enters or she enters with 10 or 5 pips and it results into that 200 pip movement, there's your 1 to 20. Precision-based trading is important. every trading style or approach that doesn't include the aspect of precision or the mathematics involved or the importance of being precise in order to understand how it affects or increments your profitability is shysting you on your ability to profit, because all of which should be reflected on your trading log, if this is true, is your 1% losses, small losses, your 1 to 2, 1 to 4 wins. Those are small gains. So those are 1 to 2, 2%, 1 to 4, 4%. And those big gains, those 1 to 10, 1 to 20, 1 to 30. Maybe you held for weeks and it turned into 50 or 1 to 100. That's all that those 3 instances, examples, are all that should be reflected in your trading log. And once you learn how to operate in the lower time frames, you'll be able to see when price action is moving against you, and a lot of times break even. Those small losses won't even equate to your risk, your constant risk. It might be a little less because you operate on the lower time frames. Everything with practice, guys, with practice, it becomes permanent. It becomes something that you're just so good at. It becomes almost like a trading demo but live. The facility of just pressing the red and blue button on demo, the coldness, the detachment from money, right? You want to become unconsciously competent at this if you really want to go pro. And I just wanted to give a shout out to Ray Dalio. For those of you who don't know, I'll link one of his videos. His video goes over how he does this. The video is called The Holy Grail of Investments. And Ray Dalio expresses that the Holy Grail of Investments is, and he trades, he doesn't trade Forex, but what he did is through diversification in positive and negative or inverse correlations, through that diversification of positive and negative correlation, he was able to reduce his average parameter of risk. So he was able to find a way to reduce his average risk per order without reducing the reward. And he says that's interesting. And that's what he deems as the Holy Grail of investment. So when I saw this video a few months ago, I was, a little light bulb, and I thought, well, no cap, that's what we're doing with Forex. We've been able to identify or reflect the Holy Grail of investments for Forex, right? Low risk, high reward. And it's beautiful, guys. So that's pretty much the whole rundown of probability and profitability, you guys. So I hope you enjoyed this video. Leave any comments with questions down below. Make sure to press that like button, share with a friend that can take value in this, and don't forget to hit that subscribe button so that you may be notified upon the next video release. And as always, guys, I'll see you all on the next one.